2024 has delivered notable upward momentum for the S&P 500 with already 20 all-time high closes year to date. For some context, we haven't seen momentum across equities like this since back in 2021. So where do equities go from here, and what can we expect from the Q1 corporate earnings season? We will break it all down for you right here on UBS Trending. Hi everyone, welcome to UBS Trending. I'm your guest host, Dan Cassidy. I am joined today here in the studio by Matthew Tormey to break down the latest Q1 earnings reporting. So with that, Matt, it's great to be with you today. So with that, Matt, I have to ask up front, with Q1 reporting underway, what are CIO's expectations for reporting this season? And secondly, you think about the drivers of earnings. Will it be more so Q1 reporting itself as far as what will be driving equity market performance? Could it be as well rate cuts, monetary policy, or perhaps even a combination of both?
Yeah, so a lot to unpack there, Dan.
Sure.
So I think one way to think about it is back at the beginning of April here in New York, we experienced a 4.8 magnitude earthquake, which was one of the largest to hit the region in over the past century. Now, if I were to compare this earnings season with the strength of this earthquake, I think it would come in higher on the Richter scale, and here's why. If we look at S&P 500 performance over the past 6 months, it's among one of the strongest returns going back 80 or so years. And what this has done is it's lifted different valuation, sentiment, and positioning indicators to elevated levels, meaning better earnings trends are probably one of a few positive market dynamics that are being priced into large cap stocks today. Now, with the stronger market performance putting an even brighter spotlight on this earnings season, we are expecting S&P 500 earnings to grow about 7 to 9% this quarter, which is similar to the rate that we saw in the fourth quarter of last year, and relative to consensus does represent a beat of about 4 to 6%. And there are a few factors that give us conviction in this view. So first, if we look at the results from the early reporters, they were quite good, and this is usually a good indication of how the balance of the earnings season will play out. Second, not only has the labor market data been strong, but key economic indicators that historically correlate well with better earnings trends are improving. And third, the surge in AI investment continues to show signs of very strong momentum. So if I were to think about what the key drivers for stocks will be going forward, you mentioned it, Dan, I think it's going to be a combination of both earnings and Fed policy, right? Because if earnings growth ends up coming in better than our expectations, and if the Fed ends up cutting rates by more than twice this year, which is our base case, then this does suggest that stocks should have further upside from here.
Well, I can attest to the strength of that earthquake, having felt it all the way up in Connecticut, having originated in New Jersey, so it was quite remarkable. So I want to talk about the Magnificent Seven for a few moments, and to provide some context for our viewers, that's a collective of consumer discretionary, information technology, communication services names. How much of a factor will the Magnificent Seven be in growth going forward from your estimation?
So simple answer, yes, the Magnificent Seven will still be very important this quarter, despite for expectations for their earnings growth to actually slow to just more than 40% on a year-over-year basis. However, one theme that we think will begin to play out this earnings season is a broadening out of the earnings backdrop. So if we look at S&P 500 profit growth over the last 4 quarters, all of it's been driven by the Magnificent Seven companies. But starting this quarter, we are expecting profit growth for the S&P 500 companies, excluding the Magnificent Seven, to be modestly positive once again, and this should accelerate throughout the course of the year. And from a sector standpoint, we're also encouraged to see that forward estimates are rising for every sector now, which is providing us with further evidence that the earnings backdrop is indeed broadening out, which ultimately should be supportive for other areas of the equity market as well as small caps.
So I have to ask, from CIO's vantage point, as an equity investor, how should I think about positioning for this current environment, Matt?
So here in CIO, we do have 2 messages in focus that are influencing our positioning recommendations. So First, we recommend investors optimize their exposure to the tech sector. Now, this doesn't mean we think investors should just go out there and load up on tech stocks and not think twice about it, but instead, we think this involves a diverse and strategic exposure to the sector that will help limit losses in the case of any consolidation. So within tech, we like AI infrastructure companies with strong pricing power and competitive positioning, as well as platform and application beneficiaries. And among the different industry groups, we do like semiconductors here, as we think the group should benefit from a bottoming in PC and smartphone end markets. And the second message in focus is looking for opportunities beyond technology as well. So two other sectors we're currently recommending are healthcare and industrials. And we do continue to have a preference for small caps, as we do believe the group should benefit from a broadening out in the earnings backdrop, as we were discussing earlier, Dan, lower interest rates, as we do still expect the Fed to cut rates later this year, and very attractive valuations.
Well, Matt, sounds like a few considerations there when it comes to equity positioning, though. Thank you for dropping by. As always, great catching up with you, hearing your thoughts when it comes to expectations for the Q1 reporting season, as well as near-term equity performance, and of course, to wrap up on positioning. So thank you again, Matt. Appreciate it.
Thanks, Dan.
For more information, visit ubs.com/views. Make sure to follow UBS on social media, including LinkedIn, Facebook, Instagram, and Twitter. And check out our Instagram channel at UBS Trending for UBS Studios content that you can't find anywhere else. And as always, if you have any questions about your portfolio, please be sure to speak with a UBS financial advisor. Until next time, I'm Dan Cassidy. Have a great day, and remember to keep your eyes on what's trending.